Welcome to the video. Today we will challenge the idea that certificates of deposit are a safe path to wealth for young savers with long horizons. If you have 7 or more years until your goal, your greatest asset is time. And we will show why CDs can quietly erode purchasing power and how a simple, diversified investing plan can put compounding to work for you. In this agenda, we will cover why CDs often fail long-term, how to build an emergency fund, how to use a Roth IRA for tax-advantaged growth, what to buy inside the account to keep things simple, and how to automate contributions. We'll also include a couple of short quizzes to reinforce the ideas. The central problem is that CDs provide nominal returns that are usually close to inflation after tax, sometimes below, which means your real purchasing power can stagnate or decline. Over a multi-year horizon, broadly diversified stocks historically have offered higher expected returns by tapping into global economic growth. The trade-off is accepting volatility in exchange for significantly higher long-term potential. This section explains that CDs often produce nominal returns that, after paying taxes, may barely match or even fall short of inflation. The result is a low or negative real return, which means losing purchasing power over time. Additionally, there is an opportunity cost, because funds in CDs do not participate in the long-term compounding of diversified equity markets. The perceived safety today can result in a funding shortfall for future goals. Before investing, establish an emergency fund equal to 3 to 6 months of essential living expenses. Keep this money liquid and separate, such as in a high-yield savings account or a money market fund. The purpose is to handle unexpected costs without selling investments at a bad time. Only access this fund for genuine emergencies. To set up a Roth IRA, choose a low-cost brokerage. If you have earned income and meet eligibility rules, open a Roth IRA. Automate weekly contributions from your checking account. Turn on dividend reinvestment, and either rebalance annually or select a target date fund that adjusts allocations automatically over time. Inside the Roth IRA, keep the portfolio simple. One option is a single low-cost total world stock ETF that captures thousands of companies globally. Another option is a long-dated target date fund that automatically rebalances and shifts allocation as you approach retirement or a far-off goal. The purpose of simplicity is to achieve extreme diversification at low cost and reduce behavioral errors. This comparison highlights that CDs offer predictable, low-volatility returns that often approximate inflation after taxes, resulting in limited real growth. In contrast, diversified stocks are volatile in the short term, but historically provide higher expected returns by capturing global economic growth. Inside a Roth IRA, gains can compound tax-advantaged, improving long-term outcomes. This timeline maps actions from today through 2030. In early 2024, set your emergency fund target. In the next quarter, open your Roth IRA and automate weekly contributions. From 2024 through 2030, consistently invest in a single diversified fund, such as a total world ETF or a target date fund. Each year, increase contributions as your income grows, and either rebalance or confirm that your target date fund's glide path remains appropriate. In 2030, review your progress and adjust goals and contributions as needed. This section illustrates how small weekly contributions can grow significantly over time through compounding. While results vary, diversified equities have historically outperformed cash-like instruments over long horizons. The example uses a weekly contribution of $50, a 7% annualized return assumption, and a 7-year period to show an approximate future value in the low $20,000 range. This is an illustration and not a guarantee. Quiz question. Before investing in stocks for long-term growth, what should you build first? Options: an emergency fund covering 3 to 6 months of essential expenses, a 1-month buffer, and then all in on stocks. No cash buffer is needed if you are young, only certificates of deposit. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is an emergency fund covering 3 to 6 months of essential expenses. This prevents forced selling during market downturns and supports long-term investment discipline. Quiz question. For a simple, diversified approach inside a Roth IRA with a 7+ year horizon, which option aligns with the strategy in this video? Options: a single low-cost total world stock ETF or a long-dated target date fund. Picking the next hot penny stock. Timing the market based on headlines. Holding cash or CDs to avoid all volatility. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is a single low-cost total world stock ETF, or a long-dated target date fund. This approach offers broad diversification, low costs, and simpler behavior, which increases the likelihood of staying invested through market volatility. This is educational content and not individualized financial advice. Investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. Consult a licensed professional for advice tailored to your specific situation. These are the key takeaways. With a horizon of 7 or more years, equities typically make more sense than CDs due to higher expected returns. Start by building an emergency fund of 3 to 6 months. Use tax-advantaged accounts like a Roth IRA. Choose a single diversified fund, such as a Total World ETF, or a long-dated target date fund. Automate contributions and stay disciplined. To summarize your next steps, set your emergency fund target and open your Roth IRA. Automate weekly contributions. Choose one diversified fund and enable dividend reinvestment. Each year, increase contributions as your income rises and review your allocation. By 2030, you will have built a meaningful investment base. Thank you for watching. If you found this helpful, please like, share, and subscribe. Tell us in the comments what step you will automate this week and what your 2030 goal looks like.